Hello there and welcome to Level 2 Intercorporate Investments. My name's John Bone. I'm an ACA and hold the CFA designation. ACA is a UK equivalent of a CPA, essentially. Okay, so we're going to be looking at intercorporate investments within this reading. It's a huge reading. It's going to take us all the way from passive investments all the way up to accounting for subsidiaries and variable interest entities. And it's really covered by 3 LOSs for the whole lot. Number 1 is we're going to have to describe the classification, measurement and disclosure of each type of investment. Number 2, we're going to have to talk about the differences between US GAAP and IFRS. And number 3, we need to talk about how each method affects the ratios we calculate. Okay, so let's get straight into our reading. So here are corporate investments. Really what we're talking about is how we account for debt and equity held in other companies. Okay, so we're going to first of all talk about investments in financial assets. Now, financial assets, the key really that we're talking about here is passive ownership. Okay, so we're talking about passive if we're looking at financial assets. Now, in the past, the US used to use bright line criteria, and it used to argue anything less than 20% was by definition passive. These days, those share ownership criteria are used as a guideline. The key point here is that you do not have any influence over the other entity, you do not have any control. That is more important than your share ownership. Now, if you do have influence but not outright control, then we're going to refer to these as associates. And associates, we're going to do something called equity accounting for our associates, which we'll see later. Notice the bright line criteria, again an indication of potential influence, 20 to 50% ownership. Okay, now again, it's an indication, the share ownership, it is not the be-all and end-all. The key thing is you have some kind of influence over the financing, investing, operating decisions of the other company. Now, of course, then finally, we look at control, where we actually control the other entity, and of course we're going to refer to these entities as subsidiaries, and we're going to do something called consolidation, otherwise known as acquisition accounting. So you have control, typically over 50% shares, because of course then you could appoint and remove directors, but again, you could have less than 50% ownership, but if you have control over the investing, financing, operating decisions, it's a subsidiary, you must consolidate. So remember, those bright line criteria used to be the be-all and end-all under US GAAP because they used to go for legal substance over economic form. Post-Enron, of course, that's changed. They now go for economic substance over legal form, so they're now just a guideline. Okay, now, of course, the other idea that we need to talk about is sharing control, in which case we talk about a joint venture. Okay, and we're going to see that there's a slight difference between US GAAP and international accounting standards here. Okay, so let's have a look at the methods that we can use for each one. Investments in financial assets are passive investments. Notice US GAAP and international accounting standards exactly the same here. They both say either amortized cost or fair value, and we're going to look at those in more detail in a second. Investments in associates. So here's these entities which we influence but do not control. Well, of course, you can see both methods say we have to use something called equity accounting. We're going to refer often to equity accounting as a one-line consolidation, because one line appears in our income statement and one line appears in our balance sheet. Joint ventures, now here's the big difference, of course. Notice under US GAAP, you equity account, whereas IFRS gives us a choice to proportionally consolidate, which we like as an analyst, or equity account, which we don't like. Rather sadly, IFRS will be changing soon and proportional consolidation will disappear as part of the harmonization process between US GAAP and IFRS. Business combinations, we're going to use a method called consolidation, otherwise known as the acquisition method, and again you can see that's consistent between US GAAP and international accounting standards. Okay, so now what we're going to do is we're just going to take each one of these categories in turn and talk about the actual accounting treatments behind it. So the classification, the measurement and disclosure. So let's start off with our passive financial assets. Now with our passive financial assets, essentially we have 3 major classifications. Okay, now you're going to see there's a 4th classification as well, but 3 major. The 3 major ones for our exam: held to maturity, available for sale, and trading securities. Let's start off with our held to maturity. Now the clue, of course, is somewhat in the title here. Held to maturity would indicate, therefore, it applies to debt securities. And it must apply to debt securities only because only debt, of course, has a maturity date. Equity is perpetual. So it only applies to debt securities. And note, the company has to have two things here. The intent to hold to maturity and the ability to hold to maturity. In other words, they're not going to have to sell these suddenly for liquidity purposes. Now, if you can treat them, if you have debt securities and you have the intent and ability to hold to maturity, then you can use this held to maturity classification. The significance is, in our income statement, we will have interest income. Okay, and actually our interest income will be coupon plus or minus amortization. Now, amortization of premiums and discounts. Okay, if you're amortizing a discount, it's going to increase the interest income, so it'll be a plus. If you're amortizing a premium, it's going to decrease it. Again, don't worry too much about that just yet. We will come back to this idea of amortization of premiums and discounts in a little while. All I want you to take away right now is that the interest in the income statement is not just simply the coupon on the bond. Now, what about our balance sheet? So let's have a look at our balance sheet. Very similar treatment here under US GAAP and International Accounting Standards. US GAAP says recorded at cost, including any transaction costs. International Accounting Standards say fair value, including transaction costs. Well, presumably, fair value would be what we paid for it when we acquired it anyway. So I can't really see a huge amount of difference between US GAAP and IFRS here. Okay, so initially what we're going to do really is record them in our balance sheet at the purchase price, what we paid to acquire these debt securities. Now, in subsequent balance sheets, we're going to hold them at amortized cost. Now, if you the idea here with our amortized cost is if you bought the bond at a discount to par, what we want is that bond assets to increase over life until it sits at par at maturity. So we're going to amortize the discount, we're going to add it to the asset each year, and we're going to add it to the interest expense in the income statement each year. Sorry, interest expense, I should have said interest revenue. We're looking at investments that we hold. I do apologise. Okay, so we're going to hold it in the balance sheet at amortized cost. We're going to increase the balance sheet asset if we're amortizing a discount. We're going to decrease the balance sheet asset if we're amortizing a premium. So eventually, over the life of the bond's life, it tends to par. So at the maturity, it's sitting there at par. So when the bond matures, all that happens, of course, is we get a repayment in of the par value and eliminate our asset. Okay, now changes in market value are not recognised. The key point here with held to maturity is we're going to hold it at amortized cost. Fluctuations in its fair value over time are not recognised unless we have an impairment, of course. Now remember what our impairments are from level 1. An impairment, of course, is if the fair value of an asset falls below its carrying value. So if the fair value of a held to maturity security was to fall below the balance sheet value and you believed it to be relatively permanent, you would have an impairment and you'd have to write down your held to maturity security to its fair value and show the other side of it as a loss going through your income statement. Now notice, if we reclassify out of held to maturity into available for sale or trading securities, or if we actually dispose of the held to maturity debt prior to maturity, then it may lead to disallowance of the held to maturity classification. We often refer to this disallowance as tainting. In other words, if you dispose of your debt or reclassify it, clearly what you're actually then demonstrating is you did not have either the intent or the ability to hold to maturity, and therefore you're not allowed to use held to maturity going forward. Anything that you had left in held to maturity would have to be reclassified outwards. Okay, that's our held to maturity. Now let's talk about held for trading, which is the name we get under US GAAP, or fair value through profit or loss, which is the name we get under International Accounting Standards. Now this applies, notice, to both debt and equity securities, and you can see these are acquired for the purpose of selling in the near future. So we're really talking about debt and equity securities that are purely speculatively held investments. So what kind of company would hold securities under the trading classification? Or maybe an investment bank holding big portfolios of investments for itself, i.e. principal position. Okay, now, interest and dividend income reported on the income statement. Absolutely. Now, again, rather bizarrely, just be aware that if you're looking at debt, the interest is going to be exactly the same as it was under the held to maturity. In other words, we're going to be seeing coupon plus or minus amortization of discount and principal. And that's going to go through our interest received in our income statement. If you've got equity, of course, you're going to receive dividends. Now, the difference with held to maturity is really when we look at our balance sheet. And you can see with our balance sheet, this time we're going to be reporting at fair value. In other words, we're going to mark to market these securities. So if they've increased in value, we're going to raise their value in the balance sheet. If they've fallen in value over time, we're going to decrease their value. What this means, of course, is we're making unrealized gains and losses as we record their fair value. Unrealized gains if their fair value has risen, unrealized losses if their fair value has fallen. Okay, we call them unrealized gains and losses because we've yet to dispose of the securities. So we mark them to market. The unrealized gains and losses, note where they go. They are going to go directly through our income statement. So under the trading classification, unrealized gains and losses will hit your income statement. Now our third major classification is available for sale securities. And I want you to think of it as really a hybrid between held to maturity and the trading classification. So the balance sheet, or at least the top of the balance sheet, is going to be looking at very, very similar to to the trading securities. And yet our income statement is going to look rather like held to maturity. So notice our income statement, it's going to be essentially interest and dividends as we receive them. Again, the interest is consistent with the other methods, so it's going to be our coupon on any bonds that we hold, plus or minus the amortization of premiums and discounts. Remember, a discount is going to make your interest received higher. If you're amortizing it, a premium is going to make the interest received lower. Okay, so remember, premium is when you buy the bond above par, discount is when you buy it below par, but we'll talk about that in more detail in a second. Now notice, in the top of our balance sheet, in our assets, similar treatment to the trading securities, we're going to hold at fair value. In other words, we're going to mark to market each period and record the asset at its fair value rather than its historic cost. The difference is where we take the unrealized gains and losses. Under trading securities, we took our unrealized gains and losses and we took them directly to the income statement. Here we don't. Here, we're going to take them directly to stockholders' equity. Okay, so they go directly to stockholders' equity, and it's only when we actually physically dispose of the securities that we'll show a realized gain or loss in our income statement. So, available for sale securities could be debt, could be equity. Notice our definition is they're neither held for maturity or trading securities. The basic idea is these are securities that you may dispose of for liquidity purposes. You could see them sitting in current assets, you could see them sitting in long-lived assets. Probably more likely to be long-lived assets. Right, this fourth classification that I mentioned very briefly is designated at fair value. Notice you have an option if you elect to use it, so it is an option to report financial assets and liabilities that would have either been held to maturity or available for sale at fair value. In other words, what you can say is, I have some held to maturity securities, I have some available for sale securities, I elect to treat them as if they were trading securities. So we call them designated at fair value. So in which case we're going to record them in the balance sheet at their fair value, just like we did with our trading securities. Here's the big difference though. Unrealized gains and losses will go now through the income statement, just like they did with the trading securities. Okay, so in other words, designated at fair value just allows you to treat financial assets and liabilities as if they were trading securities if you want. Now, you can't pick and choose. Once you've designated fair value, that's it for the life of the security. Right, let's have a look at our overall classifications of our securities then. Trading stroke fair value, well, the balance sheet, you can see value, if we treat it as trading securities, is going to be recorded at fair value. Now remember, trading is the US GAAP name, fair value through profit or loss is the international accounting. So we mark to market and record it at fair value in the balance sheet. In our income statement, we're going to see dividends if it's equity investments. We're going to see interest if it's debt. Remember that interest, of course, will be coupon plus or minus the amortization. We'll see realised gains and losses on assets we've actually disposed of, but we'll also see the unrealised gains and losses as a result of the fair value adjustments in the balance sheet on assets we've yet to dispose of. Available for sale, remember, in our balance sheet, we're going to record the investment at fair value, but we're going to take the mark-to-market gains and losses directly to our stockholders' equity, not via the income statement. So that means when we look at our income statement, we're just going to see dividends, interest, and of course interest being coupon plus or minus amortization, and any realised gains and losses on disposal. Held to maturity, difference of course in our balance sheet. This time we don't mark it to market, so it's not going to be sitting there at fair value. Instead it sits there at amortized cost. Remember, amortized cost is amortization of premiums and discounts. Okay, so in the income statement we see interest, coupon plus or minus amortization, and we would see any realised gains and losses on disposal, although I would point out to you that we shouldn't really be seeing realised gains and losses on disposal, because remember, for it to be held to maturity, we had to have the intent and the ability to hold to maturity. So if we did have realised gains and losses, we'd end up tainting our held to maturity and wouldn't be allowed to use it in the future. Okay, now, overall little points here, therefore. Unrealised gains and losses only hit the income statement under the trading, fair value through profit or loss classification. Cash flows, dividends and interest, so cash flows, dividends and interest, and realised gains and losses on actual disposals always go through the income statement. Okay, now of course, just be a little bit careful, because actually the cash flows for equity, the dividends we receive will hit the income statement. Just be aware that when we look at the interest received, it's not simply the coupon we receive, it's the coupon plus or minus the amortization. There's a little bit misleading there to say cash flows for your debt securities. Right, okay, pushing along. Let's talk about the differences between US GAAP and international accounting standards. Well, what you'll notice is there's not many here. Really, when we look at trading or fair value through profit or loss, it's pretty much the same under both US GAAP and international accounting standards. Balance sheet fair value, income statement, interest, dividends, realised gains and losses on disposal, and also those unrealised gains and losses due to your fair value adjustment. International accounting standards are the same. Available for sale, remember these are the securities that we may sell for liquidity purposes. US GAAP, record them at fair value in the balance sheet. Okay, unrealised gains and losses as a result of these fair value adjustments taken directly to stockholders' equity. Okay. In our income statement, we'll therefore see interest, dividends, and the realised gains and losses on securities we've actually disposed of. Now notice here we do have a difference between international accounting standards and US GAAP. Now, US GAAP, and it's to do with available for sale securities held overseas. Because if you think about it, essentially, you've got two sources of gain and loss. You've got the fluctuation in the market value of the investment, but you've also got, of course, the change in value in your reporting currency as exchange rates move. Now, US GAAP does not require you to split exchange rate gains and losses and market and gains and values in the investment in its domestic currency apart. We can just take all of the gains and losses essentially directly into our stockholders' equity under US GAAP. International accounting standards, however, does require us to make a split. We've got to look at the change in value of the security in its domestic currency and take that as the unrealised gain and loss and put that into our stockholders' equity. However, any gain and loss resulting from exchange rate changes, that has to go to the income statement under international accounting standards. So the overall unrealised gain or loss essentially has to be split under IFRS between exchange rate gains and losses and market value gains and losses. Exchange rate gains and losses to the income statement. Anything as a result of market value in the domestic currency of the investment fluctuating, that goes to stockholders' equity. Held to maturity, of course, are our securities that we will not sell. They're going to be held in the balance sheet under US GAAP at amortized cost, which means, remember, originally purchase price, but if you bought it at lower than a discount, the amortization will increase the value of the asset until eventually at maturity it's sitting there at par. If you bought the bond at a premium, above par value, of course, the amortization is going to reduce the asset over its life until it ends up at par at maturity again. So amortized cost in the balance sheet, the interest, of course, is going to hit our income statement, and any realized gain or loss on disposal. But remember, we should not be disposing of these prior to maturity, so we shouldn't really be seeing that. No difference between US GAAP and IFRS. Okay, goodness me. Let's talk about our debt instruments. Held to maturity. Okay, so coupon and amortization of discount and premium will go through the interest receivable in the income statement. If we amortize a discount, it will increase interest receivable. If we amortize a premium, it will reduce interest receivable. And we've got a numerical example of that coming up in a couple of slides' time, if you're a little bit worried. Okay, so amortized cost is essentially just going to be the opening balance sheet value plus that year's amortized discount or minus that year's amortized premium. So essentially the balance sheet asset is going to change each year by that period's amortization. Available for sale. Well, if you've got debt instruments, the interest going through the income statement will be exactly the same as held to maturity. In other words, it's the coupon plus or minus any amortization of premium. In fact, for trading stroke fair value through profit or loss, it's the same. No matter what classification you use, the interest receivable in the income statement is always going to be coupon plus or minus amortization of premium or discount. Now in our balance sheet, of course, under available for sale, we're going to record at fair value. And we're going to take unrealized gains and losses directly to stockholders' equity. Now, maybe we should talk about what the unrealized gain or loss is. Essentially, this unrealized gain or loss is going to be the difference between the asset's fair value. Oops. Let's change that to a 10, that would help. Fair value compared to the amortized cost that you would have had under held to maturity. That is going to be the total unrealized gain or loss. In fact, that's going to be how we calculate it for available for sale and trading securities. So it's the difference between the fair value of the security and the amortized cost figure that you would have had under held to maturity. Again, I don't want you to worry too heavily about that. We're going to see it in the example in just a second. So trading securities, again, the interest going through the income statement is the same. It's essentially coupon plus or minus amortization. But we've also got the unrealized gains and losses as a result of our fair market value adjustments hitting the income statement, of course. Okay, in our balance sheet, the asset sits there at fair value. Right, it's time to do an example and see all three methods in action, I think. So let's have a look at Acme Corporation. Purchased a 3-year, 6% annual coupon bond. Okay, remember, assume semi-annual in the exam unless they say annual. We've just kept it annual here to keep things simple. So 3-year, 6% annual coupon bond. They bought it paying $900.53. The market rate when the bond was issued was 10%. The bond was worth $950 at the end of the first year, and we sold the bond at the beginning of the second year for $955. Okay, determine the balance sheet and income statement amounts if we treat it as held to maturity, trading, or available for sale. Okay, so let's talk about bond amortization if you were a little bit rusty on that. So notice the carrying value starts off in the first year at simply being what we paid to acquire the bond. We then work out our interest income by using essentially the market rate when the bond was issued times the opening carrying value. I say when the bond was issued, I should really say when the bond was purchased, shouldn't I? So in other words, interest income here is what you paid for the bond, carrying value initially, times the market rate when you acquired the bond. So if we take 10% times the opening carrying value, 10% times 953, we get interest income of 90.05. Now our bond pays out a coupon of $60. The difference between the interest income in our income statement and the coupon in our cash flow statement is the amortization of $30.05. So we take that $30.05 and we do two things. It gets added to interest income, which is why we show 90.05 in the income statement. The other thing is it gets added to the balance sheet asset at the end of the period. So at the end of year one, beginning of year two, our balance sheet asset is now sitting there at 930.58. Again, we then take 10%, the market rate when we acquired the bond. Again, if market rates have fluctuated in the market since acquiring the bond, irrelevant. It's the market rate when you acquired the bond that you always use. So 10% of 930.58 gives us 93.06. Compare that to the coupon. The difference of 33.06, that's the amortization added to the asset, of course, and that means the asset at the end of year two, beginning of year three, is now 963.64. 10% of that, 96.36. Coupon 60, so the amortization is 36.36. So at the end of year three, the balance sheet asset is sitting there at $1,000, i.e. par value. And then, of course, what happens when the bond redeems is we receive cash. Our cash is going to go up by $1,000, and we just reduce the asset by $1,000 because we no longer hold the bond once it's redeemed. And that's the double entry. So, of course, you can see if you hold it to maturity, there is no impact on the income statement at maturity because there is no gain or loss. The balance sheet asset is sitting there at $1,000, and that's exactly what we receive when the bond redeems. Okay, so that was just to give you a refresher on bond amortization. You did see it when we issued bonds at level 1, of course, but you saw it on liabilities, bonds as liabilities rather than bonds as assets. But it works the same way, doesn't it? So let's have a look at our held to maturity security. Now, at the end of the first year, of course, the bond is now worth $950. Do we report that under held to maturity? No, we don't. Remember, fair value is not reported under held to maturity. Instead, of course, what it will be sitting there at the end of the first year is the amortized cost. So amortized cost, we originally bought it at 900.53. The first year of amortization is 30.05, and you can lift that directly from the slide on the previous slide. Okay, so therefore, at the end of year one, there it is at amortized cost of 930.58. What are we going to see in our income statement? Well, of course, we see coupon plus the amortization. Remember, coupon 60. Amortization 30.05, so overall therefore 90.05 is what we see. Coupon plus the amortization of the discount. Okay, we then sell it for $955 at the beginning of year two, which of course we shouldn't be doing if it's held to maturity, but let's just do it for illustrative purposes. So we would taint our held to maturity if we were to do this. Because remember, the bond had 3 years, so we're obviously selling it prior to maturity. Okay, so how do we actually work out our gain or loss? Relatively straightforward. We sell for $955, so there's our proceeds when we sell. And here is our carrying value at the point of disposal. What is carrying value? It just means balance sheet value. Remember, it was sitting at 930.58 at the end of the first year. So we sold at 955. The carrying value is 930.58. So therefore, we report a gain of 24.42 when we actually dispose of this asset. Okay, that is our held to maturity. Let's then have a look at trading securities, otherwise known as fair value through profit or loss. Remember, trading securities, US GAAP, fair value through profit or loss are international accounting standards. Now, of course, this time fair value is going to be shown. Okay, so that's very clear. We are going to show fair value. Now, we were told that this bond was worth $950 at the end of year one. So that is what we want to see sitting in our balance sheet at the end of the first year, and that is what we do see, 950 sitting in our balance sheet. Now, what about the unrealized gain or loss? It's not simply the difference between the purchase price and fair market value. Not when you're looking at a bond. It would be if you're looking at equity, because you've got no amortization of premiums and discounts. But when you're looking at a bond, remember the unrealized gain or loss is going to be the difference between essentially fair value and the amortized cost figure, as if it was held to maturity. So that's what we're going to do. That's fair value we now know is 950. The amortized cost figure, we'll just go back and review your held to maturity. That was 93058, which means our unrealized gain is 1942. So just watch out for that the unrealized gain or loss is the difference, essentially, between the fair value and the amortized cost, as if it is treated as held to maturity. Now remember, for equity, we don't have any amortization, essentially, of premiums and discounts. So for equity, it would just be the literally fair value compared to what you purchased it for. Okay, so that's our amortized. So that's our unrealized gain or loss. Now remember, in our income statement, we're going to see interest income, and our interest income is going to be exactly the same as it was under held to maturity. In other words, our interest income is going to be made up of, there it is, it's going to be made up of the coupon, $60, plus the amortization of the discount, 30.05. So interest income under debt securities will be the same under all three methods. We always include the amortization of discounts and premiums. The unrealized gain or loss, remember the 1942, well, that will go through the income statement under trading securities. So we will show 1942, the difference between fair value and amortized cost, hitting our income statement. Okay, we then dispose of it for 955 at the end of the second year. So what do we actually show here? Well, we're going to show a net gain of $5. Notice what, there's two ways really of arriving at this figure. What you can do is you can reverse the gain from the previous year, because we're saying actually we've already shown 1942 in previous years going to the income statement, because we took unrealized gains and losses to the income statement. The realized gain this year is then going to be 955, what we sold it for. Okay, so again, sales price, compared to the 93058, which would be amortized cost, at the end of the last year under held to maturity. So that would say 1942, reverse that, put in 2442, and in fact we therefore show a net gain of $5 this year. So you'd actually only see $5. What we're simply saying is, look, you've got a realized gain of 2442, but you've already shown 1942 in previous periods, therefore you only need to show $5 this period. Now I think you can jump to that bottom line figure fairly straightforward by taking your sales price and comparing it to, of course, there was the fair value at the last balance sheet date. So in other words, carrying value was 950, we sold it for 955, we've therefore got a net gain on disposal of 5. I think that's really an easier way of working it. Right, let's push on to our available for sale securities. Our available for sale are going to be a bit of a hybrid, aren't they? The balance sheet's going to look a little bit like our trading securities. Well, certainly assets are, because we're going to record at fair value. But remember, we're going to take the unrealized gain this time directly to our stockholders' equity. Okay, so let's have a look at our balance sheet. Again, note the balance sheet asset is going to be recorded there at its fair market value, 950. Again, the unrealized gain is exactly the same, 1942, as it was under trading. In other words, we're looking at 950, the fair market value, and comparing that to what we would have had under held to maturity and getting our 1942. Remember that 1942 is then taken directly to our stockholders' equity into comprehensive income. In the income statement, therefore, the only thing we're going to see is our interest income being, as usual, the coupon plus the amortization of our discount. Now, in the beginning of year 2, we sell it for 955, and therefore we're going to show a realized gain, 955, okay, the selling price compared to 938.58, which would be the value that you would have under held to maturity, essentially. Now, again, there's another way you could view that. You could say, essentially, okay, this total 2442 is made up really of two things. It's made up of, I sell at 955, and my carrying value in the balance sheet was $9.50. That gives me a $5 gain. And also I'm going to take out all of the unrealised gains and losses from my comprehensive income and now put them in the income statement. So, okay, so I've then also got the 1942 sitting in my income statement, giving me overall 2442. So in other words, 1942 is coming out of stockholders' equity in comprehensive income, and it's now being put into the income statement. Good. So those are your three methods. Make sure you can do those for the exam. Make sure you know, therefore, how the balance sheet changes under each of those three methods. Right, we then push on to our next method, and our next method is going to be looking at equity accounting. And remember, we do our equity accounting if we have significant influence. The old bright line criteria were 20 to 50% share ownership. Remember, these days, it doesn't really matter about share ownership. The key point is you have influence. And if you have influence, you will call it an associate. US used to call them affiliates. So if you see affiliate, it just means the same as associate. And we have to do something called equity accounting. Now, equity accounting is called a one-line consolidation because we'll see one line in our balance sheet and we'll see one line in our income statement. Okay? So what are we going to see in our balance sheet? Well, initially it's going to be reported at cost, i.e. what we paid to acquire the equity in our associate. But then we're going to bring in earnings minus dividends. Now, what do we mean by earnings minus dividends? We're going to bring in our share of the associate's earnings. So we take its net income for the year. If we own, let's say, 30% of it, we bring in 30% of its net income. Now, of course, it then pays out a dividend. So, again, we then subtract our share of its dividends. So if we own 30%, we take out 30% of its dividends. So the balance sheet asset essentially is changing each year by the earnings pickup, as we call it. And the earnings pickup is simply just our share of its net income minus our share of its dividends. Now, of course, we can see down there, the change in the balance sheet investment is equal to our share in the company times its earnings minus our share in the company times its dividends. Now, of course, that could just simply be said, our share in the company times its earnings minus its dividends, and earnings minus dividends, of course, are its change in retained earnings. So what we're doing is we're increasing our investment in our balance sheet by our share of the investment's change in retained earnings each period. So that's what's going to go on in the balance sheet. In the income statement, note, we are just going to bring in our share of its earnings. Well, let's see that in place. Let's go straight to an example. Oh, sorry, not straight to an example. Straight to evidence of significant influence. So this is what International Accounting Standards says to look for to identify influence. So the key one is really that you have representation on the board of directors of this other company. You have participation in their policy making, so investing, financing, and operational decisions. There are material transactions, that are material sales between the two companies. Interchange of key personnel, so in other words, you loan this other associate some of your staff, or maybe technological dependency, the two companies are dependent on one another for sharing some form of technology. So we get to influence the financing, we actually also get to influence the investing, the operations, and the amount and timing of the dividends that this associate pays. Right, into our example. Briatore here, Incorporated, they invest $400 million in Pagliardini Enterprises for a 40% stake on the 1st of January X4. Earnings and dividends for the next 2 years are, so we've got the associates' earnings, 100 million in X4 and 20 million in, of dividend in X4, and in X5, 120 million and dividend of 30 million. Okay, let's get straight into this and have a look at how we actually record it. So what we're going to do, essentially, you can see initially our opening balance, there you are, original investment, is recorded there at 400 million, what we paid for it. Now, in year one, we're going to bring in our share of its earnings. We've got a 40% stake in this company. Its earnings were 100, I believe, from the previous slide. So 40% of 100, don't need to do that on the calculator, 40. Now, we also bring in our share of its dividend. The dividend it paid out was 20. 40% of 20 is going to be 8. So you can see, therefore, that what we're really saying is the Pagliardini Enterprises, the associate, If its earnings went up by 100 and its dividends it paid out dividends of 20, its retained earnings increased by 80. We're bringing in our share of that, 40% of 80, giving us 32. So our investment has increased by 32. Now, in the parent company's income statement, we're just going to show our share of its net income, 40. Now, students look at this and they say, hang on a second, the balance sheet asset has gone up by 32 million, but net income and hence stockholders' equity has gone up by 40 million. And in other words, when you think about your balance sheet equation, assets equal liabilities plus equity, people go, oh, well, that's gone up by 32, and yet my equity has gone up by essentially 40 in year one. How does it balance? Well, it's because assets hasn't just gone up by 32. What else happened? You received a dividend of 8, of course, which means actually the assets, you've got an increase in cash as well of 8, the dividend that you received. So actually assets went up by 40, equity went up by 40. So just watch out for that little trap there. People do think, oh, how does this all work? How does it all balance? Okay, where do we show that income in our income statement? It tends to get shown after operating income but before tax. So it'll be normally after our continuing operations, essentially. Okay, so there we go, 40. So let's have a look at the second year. So notice now our starting investment is now going to be 432 million, last year's closing investment. This is going to increase by our share of its net income. Our share of its net income, year two's net income 120, we own 40% of it, so 48. So there you go, 48 there, and also 48 shown in our income statement. Our share of its dividend in year two, it's going to pay out a dividend of, you've lost the data, where was its dividend? 30 million. 40% of 30 million, 12, there we go. So in other words, its retained earnings went up in the period. Our share of its retained earnings is 36 million, so we increase our investment by 36 million. Again, the balance sheet is going to work still because we received a dividend of 12 million and our cash has gone up by 12 million. Okay, that's the basics of equity accounting, very much the basics. What we're now going to say is, what about if we purchase the stake in our associate and we pay more than the book value of their net assets? Okay, so we're going to use the example of Briatore, where we purchased 40% for 400 million, but now we're going to look at Pagliardini's book value of its net assets and fair value of its net assets at the date of acquisition. Well, you can see the book value of its total assets was 1,450 here. The liabilities 1,000, so it had net assets here of 450. Okay. Now we've acquired 40% of those net assets, so let's just think about what 40% of those would be. Essentially, what we're saying is we've acquired net assets, 40% of net assets, we've acquired net assets worth 180, and we paid 400 million to acquire them. Now let's look at the fair market value adjustments. When we actually acquire an associate, what we're asked to do is take its balance sheet at the date of acquisition and restate its balance sheet to fair market value. And you'll notice here that we do have an adjustment on our plant, property and equipment. Our plant, property and equipment here is higher by 250. So that is known as our fair market value adjustment. And notice that therefore total assets is higher by 250, and therefore net assets is higher by 250. Our share of that, 40%, 700 times 40% gives us 280. Okay, so let's have a look. So there's our purchase price, 400 million. 40% of the book value of net assets, the 180 that we looked at on the previous slide, and we get our excess purchase price. We paid an excess of 220. Now we're going to split that excess between fair market value adjustments. And remember, we saw the fair market value adjustment to the PP&E was 250 million. We own 40% of this adjustment, so 250 times 40%, that gives us our 100 million. Okay, so take 220, less the fair market value adjustment, or our share of the fair market value adjustment, 100, and the balance is goodwill. So we have goodwill of 120. So actually, and this is the key point, when we look at our balance sheet, remember this is a one-line consolidation. So all we're actually going to see is the 400 million figure, the purchase price. Okay, we're not going to see these three things split out separately. We're not going to see here essentially is the net assets you acquired, 180. We're not going to see here is the fair market value adjustments, 100, and here is the goodwill, 120. We're not going to see those separately. They're all included in that one figure. So the goodwill figure of 120 million is included in the carrying value of your associate. It is not separately shown as an intangible asset in the parent company's balance sheet. That is the key point here. So because it's not separately shown, a lot of people would argue that there is no goodwill on associates. But we can see that that is clearly not the case. Now you might argue, why do we bother with this? Why couldn't we have just done 400 million, sorry, let me just try that again. 400 million less the fair market value of the company we acquired. 700 was its net assets times our 40% stake. That's 280. Gets you 120. Well, you would get the same goodwill figure, but I wanted to isolate this fair market value adjustment. The significance is fair market value adjustments at the date of acquisition will have knock-on impacts on future income statements, future earnings in the income statement. If essentially we've made our PP&E higher, we're going to have more depreciation in our income statement. Remember, goodwill does not have an impact on future income statements because it is not amortized, okay? So goodwill is not going to be amortized. We will have to do impairment reviews on goodwill.